Hi, my name is Bilawal Javed and I'm going to present my corporate accounting video presentation. My student ID is VSS2919. Starting, let's go with financial accounting in its true essence. It's not accepted by tax authorities for measurement and recognition of tax-related matters. Corporate accounting has tried to bridge the gap via AASP 112, which provides a framework for companies to adequately settle and offset the differences and gaps in between the two accountings, financial and corporate. The theory pertaining for accounting profit, which is influenced, is by generally accepted accounting principles and Australian accounting standards related to income taxes, tax valuation, fair value considerations, taxable profit, which is highly influenced with tax authorities ruling create temporary and permanent differences in carrying values of assets and liabilities in contrast to their tax basis. So the report we've made is for the evaluation of this theory with practical applications of ASP 112 by taking example of Fortescue Metal Group Limited, FMG they call it, and its annual report 2019, which we're going to be discussing and giving the examples inside of that, which unveils different other aspects of accounting and their respective implications over tax rulings applicable for subject company. So different other matters such as tax payment criteria, methodology is also discussed, but it comes in the later part. So let's start up with the introduction. This was just the overview that I've given you before started giving the introduction of this assignment. So this report revolves around the theory, issues, and practice for different aspects of ASP 1 and 2 income taxes, ASP 2014. The report aims at developing a second and succinct and clear understanding of corporate accounting for income tax issues and to develop an understanding on different concepts used in accounting for income tax. So it is further aimed to develop an understanding on practical implication of different concepts of income tax accounting which are used by companies in different practical settings. So it's more about the income tax and how the companies deal with the income taxes while filing up their tax every financial year in guidelines with ASP and the income tax office and how all these rulings match. For assessing application of different income tax aspects such as income tax expenses associated with deferred tax assets and liabilities, current tax implication and tax payment methodologies, we've taken, as I told you, example of a group known as Fortescue Metal Group Limited. It's one of the major giants of iron ore in Australia. It's the extraction industry is listed among top 20 Australian companies listed at ASX 50. And for analysis and understanding companies' latest financial results, we've taken the 2019's report and are used for improving understanding over matters pertaining to income tax accounting. So let's start with the concept of income tax. So once it comes, the income tax things comes out, it comes up as an accounting profit. What's an accounting profit? So an accounting profit, as determined by the conjunction of general accounting general accounting principles, normally we call it a GAAPS, and Australian accounting standards, whereupon financial statements are two main aspects of calculating the accounting profit. We've got accounting income that includes all those revenues and gains which result from conducting business activity during certain financial period, are recognized and accrued by a business based on revenue recognition criteria of mainly ASP 15 and other Australian accounting standards. And then we've got accounting expenses. That's just the formation of the costs that have been incurred in the normal course of business. That includes the cost of sales, operating costs, and so on and so on. So accounting profits comes up with by calculating those deducted expenses from the accounting income. So when you take those expenses, deducting accounting expenses from those accounting income, it comes up to be the accounting profit. So then we've got a taxable. What's taxable profit? So taxable profit is the profit amount for a financial period which is used for computation of income tax payable, the basis of rules established by obviously ATO in light of ASP 112. So while doing this taxable profit, we've got another part for it to calculate how you going to calculate taxable profit. We've got taxable revenues, then we've got deductible expenses. So in taxable revenues, they include those revenues and gains realizable under taxation rules, which are termed as an assessable income. The amount of money you could have made it, those taxable money revenue that have you calculated, that you've collected, all those revenues gains. The deductible expenses, these are all allowable deductions under tax rulings which can be used for reducing assessable income. So all those all those expenses that are deductible, allowable deductions that are under the ATO's guidelines, these are known as those deductible expenses used for reducing. They reduce assessable income because you deduct from the expenses revenues out of it. So this is what the taxable profit is. It's calculated by deducting those deductible expenses that have been gone through the ATO's guidelines from the taxable revenues. This is what the taxable profit is. Okay, now we come up with the temporary differences. So when a statement of financial position is prepared using tax laws, the value of assets and liabilities, they are termed as tax base, usually differ from the actual carrying value of an asset or a liability. So there are two types of temporary differences. There's a taxable temporary difference and there's a deductible temporary difference. Well, I'm gonna briefly explain you what both they are. So the taxable temporary difference normally arises when an asset has a greater carrying value than its tax base, or when a liability has less when a tax liability has lesser carrying value than its tax base. So thus these temporary differences result in upsurge and in income tax to be paid or diminution in income tax to be recovered in future periods. These type of temporary differences create a deferred tax liability in company's balance sheet. So it comes up in the company's balance sheet. This is this type of the temporary tax differences. Then we got deductible temporary differences that normally arise when an asset has a less carrying value than its tax base. When the carrying value is less than the tax base, or when a liability has greater carrying value than its tax base. The greater tax, when a liability is greater, as greater carrying the amount of the deductible or the liability has been greater than the tax base, that's when the deductible temporary differences are occurring. So these temporary differences are the diminution in income tax to be paid. These comes the taxable temporary differences. They upsurge the income tax to be paid. These ones, deductible temporary differences, they actually reduces it down, income tax to be paid, or an upsurge in income tax to be recovered, or it recovers the upsurge in the future periods. So this is more of back and beforehand sort of a thing that you do manage, or you can foresee that when the carrying value of the asset is fully recovered, liability is settled. These type of temporary differences create a deferred tax asset in company's balance sheet. We've got deferred tax asset, deferred tax liability. It's just because we're running short of time, it's hard to explain each and every point, but I wanted to actually discuss all of them. Then we've had more of the deferred tax assets, what been deferred tax assets, and then the deferred tax liabilities we have. Just to explain into a bit further, we've got the recognition criteria of how you do the deferred tax. Deferred recognition for any deductible temporary difference for up to its extent or probability that taxable income shall be existing against which deductible temporary difference could be utilized. Got two parts where it's not a business combination, it's one of those compositions of it, and at the time of transaction affects neither accounting profit or taxable profit. Tax is law. And we got Fortescue's latest tax expense, which is important. So the Fortescue Group's latest income tax for the year ended 30th June at financial year 2019 is reported in company's consolidated income tax as US $1,382 million. That has been reported by Fortescue in 2019 statement. So we've got then the examples of the company tax times, your firm's accounting income. Taking example of Fortescue's annual report 2019, we've got the income tax expense consolidated. It's $1,382, that's US million. Australian comes up to be 1370. In 2019, that's Australian group, because of mega giant, it's a multinational company, so it reports for the US and for Australia as well. 2018 it was 367 consolidated, and then in Australian group in 2018 it was 355. So 29.6% 2018 in Australia, 29.5% in US, and 2019 in Australia was 30.4% and 30.3% in US. So reported deferred tax liabilities, we've got net deferred tax liability collected as in 2019 US million dollars were 516, and then the deferred tax that was the asset, and the liabilities were 2204. It's total 1688 million dollars 2019. So that came up from the annual report. I'm just quickly running onto it because I'm running short of time. And we've got the concept of temporary differences and the permanent differences in the accounting system. How does it explain? And then we've got the new understanding insights about income tax accounting. So now, just to give you an idea that there have been some confusion specs for me in the overall explain. The first and the foremost was the pay as you go. There's a new pay YG people got it. System installments for tax collection. I could understand why when this system exists for companies like Fortescue, since this system only complicate the accounting for me. When a company is required to pay around 762 million US dollars with suitable evidence that the amount is correct and shows that if any amount would be overpaid, the authority would give a refund or settlement. Why the company would want to pay is $376 million for good. I understand that ATO offers this system for payers facilitation and convenience to pay tax easily. But still, I believe there should be some protocol criteria for pay-as-you-go system where it's only offered to those individuals, companies who actually qualify for paying tax in installments. So in conclusion, let me conclude by saying to conclude this the theoretical facts and practical implication of income tax accounting by Fortescue in its annual report 2019 in ASB 112 is a complex and considerate financial standard of corporate accounting which aims to bring a huge gap between the financial accounting and tax accounting, the settlement or offsetting the differences in a legitimate manner. However, there are still things such as matters pertaining to permanent differences and pay as you go, which still require further attention from standard makers. So Fortescue, on the other hand, has been highly focused to comply majority rulings of the standards which give adequate recognition, measurements, and disclosures. So this is just the idea that have been taken by the help of that company's annual report 2019, which is Fortescue Metal Group. You can go and search it. It's quite of a big company. Well, just about this income tax. I'm actually running short of time. Hopefully, you guys have liked my video. Thank you.